Welcome back to the show. Today I want to start with a scenario that sounds like it defies basic logic, and then I'm going to show you it's playing out in one of the largest sectors of the global economy right now. Imagine for a second that you own a restaurant. Not just any restaurant. You are fully booked every single night. The line wraps around the block. You are turning tables faster than ever. Your menu prices are the absolute highest they have ever been. Gross revenue is just pouring into the register. But then at the end of the month, when you sit down to do the books, you realize that somehow, inexplicably, you cannot afford to pay your rent. The math simply does not work. If the register is ringing and the dining room is packed, the underlying business should be thriving, right? If it's not, you have a massive structural failure hiding behind the scenes. That restaurant scenario, as crazy as it sounds, is exactly what is happening right now in the automotive industry. I've been through a huge stack of data, financial reports from the major automakers, consumer analyses from Edmunds and Cox Automotive, global sales figures from Trident, and deep economic analysis from Wolf Street and CBT News. And across all of these sources, there is one massive paradox staring us right in the face. We are looking at a market that is simultaneously breaking sales records and bleeding tens of billions of dollars in cash. A quick caveat before we get into it. This is a general analysis of the automotive market as a business sector. It is not financial or investment advice. We're here to look at the structural forces at play, not to tell you where to put your money. Let's get into it. On paper, 2025 was a phenomenal year for the auto industry. US new vehicle sales finalized at 16.2 million units. The best year the industry has seen since before the pandemic. And people didn't just buy cars, they paid an absolute premium. The average new car price crossed the $50,000 threshold for the first time ever, hitting a record $50,326 in December of 2025. The top line money was absolutely flowing. Now look at the reality underneath the revenue. The biggest names in the business are getting crushed. Honda just flagged a $15.7 billion electric vehicle charge. That charge is going to result in their first annual loss in nearly 70 years. Read that again. Honda has not posted an annual loss since 1957. Stellantis, the massive conglomerate behind Jeep, Dodge, and Chrysler, just recorded a net loss of 22.3 billion euros. And in case you think this is just the everyday consumer brands taking the hit, even at the extreme top end of the luxury market, Porsche saw its profits drop by over 90%. A 22 billion euro loss in a record sales year. How does that math work? Where is the leak in the bucket when transaction prices are at record highs and dealerships are moving over 16 million units? The leak is in two places, the cost of simply keeping the lights on and the massive cost of pivoting to new technology. That $50,000 average transaction price acts as a smokescreen. It hides the fact that unit volume isn't actually what it used to be. 16.2 million is a post-pandemic high, but it is still lower than the 17 million units the industry regularly moved a decade ago. Meanwhile, the underlying cost to build these cars, retool factories for new technology, and source raw materials have completely ballooned. The auto industry has become the canary in the coal mine for the broader economy. They are trapped in a vicious cycle where they have to rely on high-margin, low-volume sales, sell fewer vehicles at much higher prices, just to break even on bloated corporate overhead. They are essentially running the engine past the red line just to maintain highway speed. If we want to know where all that overhead went, the data points directly to the single most expensive gamble the auto industry took this decade, the great electric vehicle transition. Automakers poured billions into the EV pivot, and now they are desperately trying to back out. Across the industry, the tally of EV write-downs is sitting at roughly $67 billion. Ford took a $19 billion hit. General Motors wrote down $7.6 billion. Stellantis took over $25 billion in charges as they rapidly backed away from their aggressive all-electric timelines. While all that was happening, conventional hybrid sales actually surged by 27.6%. Consumers essentially said, we aren't ready for full electric, we want a middle ground. $67 billion. What does that actually represent in the physical world? There's a fascinating analyst debate on this one worth walking through. One perspective argues this is mostly clever corporate accounting. Think of it like a Hollywood movie studio that spends $200 million making a huge blockbuster, then realizes the movie is terrible. Instead of releasing it and severely damaging their brand, they lock the film in the vault and write it off as a total loss on their taxes. Automakers are writing down the book value of underutilized factories and EV research platforms to take a massive paper loss right now. And critically, because everyone is doing it in the exact same fiscal year, no single company gets punished. Wall Street analysts just shrug, blame the macro environment, and move on. It's a coordinated reset. The other perspective says no, this is genuine destroyed capital. From this viewpoint, these companies poured billions of real, actual dollars into physical factories, lithium supply chains, and dead-end chassis designs for technology that consumers simply are not adopting at the promised rate. EV sales actually fell by about 2% in 2025, down to 1.28 million units. Automakers had built the physical capacity to sell millions more than that. That money was spent and it essentially evaporated. And here's where it gets really interesting. The car makers are now scrambling to pivot back. They are loudly announcing a return to big traditional V8 engines and heavy SUVs, right at the exact moment gas prices are starting to pinch consumers again. Legacy automakers are chronically one step behind what the consumer actually wants. Here's what this means for you. Whether that $67 billion is destroyed capital or a clever tax write-off, someone eventually has to pay for it. Whether you buy an EV or a gas car, you are going to be absorbing the cost of these corporate miscalculations in the sticker price of your next vehicle. That's not editorial. That's just how the math works. That desperation for cost-cutting leads directly into the second problem. It's how the modern car lost its soul and became a household appliance. The sources call this the feature plateau. Almost every new car today is objectively good. They all have Apple CarPlay. They all have incredibly efficient powertrains, lane-keeping sensors, and interiors that would have been considered premium luxury a decade ago. The baseline for quality is incredibly high. Buying a car today feels a lot less like a passionate lifestyle choice and a lot more like buying a washing machine or a laptop. You're just comparing specs. That laptop comparison is the perfect way to understand what's happening under the hood. When you buy a laptop, you don't really care about the plastic shell. You care about the processor inside. And that is a terrifying prospect for legacy automakers because of what industry analysts call the democratization of capabilities. In the past, a luxury brand could charge you a massive premium because they legitimately had better, faster proprietary engineering. They built the engine from scratch. They tuned the suspension perfectly. Today, automakers are increasingly gutting their own internal engineering departments to save money. Instead of building it themselves, they are assembling third-party parts from mega suppliers like Bosch and Harman. If a $25,000 entry-level sedan has the exact same infotainment software, the exact same radar safety suite, and comparable electric 0 to 60 acceleration as a $60,000 luxury car, what are you actually paying for it? The incumbent brands have completely lost their ability to charge a massive premium just for the badge on the hood. They've hollowed out their own uniqueness to save a buck. If the underlying processor is identical, buyers are eventually going to buy the cheaper laptop. Here's what this means for you. Brand loyalty in the auto industry is becoming a tax. You're paying for a logo because the actual technology powering your vehicle is likely identical to the cheaper car parked next to it. If cars are becoming rolling iPads assembled from third-party parts, the biggest existential threat to legacy automakers isn't each other. It's whoever can build that iPad the cheapest. Because if brand loyalty is dead, the only thing that matters is price. And that introduces a massive disruption. The stats from Trident on the Chinese auto market are jaw-dropping. BYD, the Chinese automaker, sold 4.6 million new energy vehicles in 2025. NEV stands for New Energy Vehicle, a category that includes both fully battery electric cars and plug-in hybrids. BYD alone took 18% of the entire global EV market, and 8 of the top 10 best-selling battery electric vehicles globally are from Chinese brands. That is a market takeover. And these are not cheap stripped-down golf carts. Look at the Geely Galaxy M9. It's a luxury hybrid SUV with cutting-edge tech, incredible horsepower, and, this is not a joke, a built-in mini fridge. In China, that vehicle sells for the equivalent of $25,000. That is roughly half the price of a comparable US competitor. If you can buy a luxury SUV with a fridge for 25 grand, why aren't you seeing them at your local grocery store parking lot? Because current import restrictions keep these vehicles out of the US market. There's an active policy debate about whether those restrictions are the right approach. Reasonable arguments exist on multiple sides, and I'm going to stay out of that fight for this analysis. What matters strategically is the effect. American buyers currently do not have access to that price point. Domestic legacy brands are competing in a walled-off market where the natural pressure to build a genuinely affordable, tech-loaded vehicle simply does not exist. Here's what this means for you. If you're a consumer, your options are dramatically narrower than the global market suggests they could be. If you're an investor, understand that any future shift in the import environment in either direction has the potential to significantly reshape the domestic market overnight. That is a real unhedged risk sitting inside every legacy U.S. automaker stock price. And because American buyers are largely limited to that $50,000 domestic market, they are forced to finance the difference, which creates the fourth and maybe most concerning structural problem, the debt wall. Total consumer auto debt in the U.S. has now hit $1.68 trillion on depreciating assets. Sit with that for a second. The average monthly payment for a new car is $773. And Edmunds data shows that 1 in 5 buyers is now committing to a monthly payment of $1,000 or more. $1,000 a month just to drive to work. How are people physically affording this? In many cases, they aren't. And the pressure is compounding because the market is hitting what analysts call peak refinance. Think about consumers who bought cars during the cheap money era of 2019 to 2021 when interest rates were near zero. Those buyers are now trying to trade those cars in for a new model, but they're stepping into a market with drastically higher car prices and drastically higher interest rates, averaging about 6.39% for new cars in early 2026. Because prices and rates are so high, the trade-in math completely breaks down. If their old car depreciated faster than they paid off the principal, they're underwater on the loan. Currently, 30.9% of all trade-ins carry negative equity. Nearly a third of buyers owe more on their old car loan than the car is actually worth at the dealership. On average, they are underwater by $7,183. So picture a buyer who walks in $7,000 in the hole and wants to buy a $50,000 car. What does the dealership do? They roll the $7,000 of old debt straight into the new loan. The bank writes a loan for $57,000 and the buyer stretches the terms out to 84 months just to keep the monthly payment manageable. 84 months, which means they're paying 6.39% interest over 7 years on $7,000 of a phantom car that they don't even own anymore. That feels like a ticking time bomb for the broader economy. But there's a sharp analyst debate about how big of a bomb it actually is. One perspective points out that subprime 60-day auto loan delinquencies hit a 32-year record high of 6.9% in January 2026. Subprime just refers to loans given to borrowers with lower credit scores who are considered higher risk. That 6.9% default rate is higher than the default rate during the 2008 financial crisis peak. Analysts holding this view see cracks in the foundation of a skyscraper before the building visibly leans. The working-class consumer is completely breaking under the weight of inflation and debt, and it's only a matter of time before that pain spreads upward. The counter perspective says, look at the denominator. Subprime borrowers only represent about 17% of all active auto loans. A 6.9% default rate sounds terrifying, but this financial stress is strictly contained to high-risk buyers and the specialized secondary dealerships that lend to them. 83% of the market consists of prime borrowers who are still making their payments. So while it's a tragic situation for those specific individuals, it is not an existential systemic threat to the banking system. Both perspectives can be right at the same time. Even if it doesn't crash the macroeconomy, the individual reality is brutal. Here's what this means for you. Treating a car loan like a monthly subscription rather than long-term debt is creating a trap where you could owe thousands more than your vehicle is actually worth. If you're inside that trap, the hard truth is the way out isn't a newer car. It's staying in the current one. So let's take a step back and look at the whole board. We have a $67 billion EV retreat. We have cars turning into commoditized appliances built from off-the-shelf parts. We have a foreign market offering superior vehicles at half the price that American buyers can't currently access. And we have a nearly $2 trillion wall of negative equity consumer debt. Pull all four of those together, and you get one obvious question. Who is actually buying these 16.2 million cars? The sources point to what economists call a K-shaped market. The auto market is no longer a single cohesive entity. It has split in two entirely different directions, like the letter K. The top arm of the K represents wealthier buyers, and they are entirely propping up the new car market. A record 43% of all new cars are now purchased by households earning at least $150,000 a year. Automakers have virtually eliminated the entry-level affordable sub-$25,000 segment. Why? Because they can make higher margins selling loaded luxury SUVs to the top 10% of earners. The bottom arm of the K is everyone else. They are simply priced out of the new market entirely. They're pushed into the used market, or they're forced to take on those dangerous levels of negative equity we just walked through. It is a stark divide. So here are the practical takeaways from all of this. If you're an investor looking at legacy automotive stocks, the read is that their profit margins are a mirage. They are heavily dependent on a shrinking, hyper-concentrated pool of wealthy buyers, leaning hard on high-margin luxury vehicles to cover multi-billion-dollar EV write-downs. They are deeply vulnerable to any crack in the macroeconomic environment or any shift in import policy that would allow cheaper global competition in. Those margins could evaporate overnight. For the everyday buyer, the person who just needs a reliable vehicle to get to work or drop the kids at school, the math of upgrading simply doesn't work anymore. The smartest financial move you can make right now is to step off the upgrade treadmill entirely. Maintain the car you currently own, keep it running as long as humanly possible, and absolutely refuse to roll negative equity into an 84-month loan just to get a slightly newer touchscreen. It's amazing how often the best financial advice is essentially doing nothing. I want to leave you with one final provocative question that this whole analysis surfaced for me. We started by noting that 2025 was a record sales year. Overall volume was up 2.4%. The top-line numbers looked great. If automakers are already posting historic multi-billion-dollar losses and consumers are already drowning in debt while transaction prices are at all-time highs, what happens next? What happens when vehicles themselves become too digitally complex to repair outside of an authorized dealership and simultaneously too financially toxic to insure? That is the quiet crisis brewing just over the horizon. It's exactly like that fully booked restaurant we opened with. The dining room looks spectacular, the food is flying out of the kitchen, the menu prices are sky high, but the foundation is rotting away, the rent is due, and the cash register is still coming up short. Thanks for going down this one with me. Pay attention to who's holding the keys. I'll see you on the next one.